Are you an employee who's considering investing your hard-earned money? Congratulations! You're taking a big step towards securing your financial future. But before you jump into the world of investing, there are a few important things to consider. In this video, we'll explore some additional details and instructions to help you make informed investment decisions as an employee. We'll cover everything from understanding your employer's policies and investing in your employer's stock to taking advantage of a 401k plan and investing outside of your employer's offerings. Investing can be a complicated process, and it's easy to feel overwhelmed. But don't worry, we've got you covered. Whether you're just starting out or you're a seasoned investor, this video will provide you with valuable insights and tips to help you make the most of your investment opportunities. So, let's dive in and explore the world of investing as an employee. 1. Understanding your employer's policies. It's important to read and understand your employer's policies before making any investment decisions. This includes any restrictions on the types of investments you can make or the amount you can invest. You might also be required to report your investments or seek approval before making any investment decisions. If you're unsure about any aspect of your employer's investment policies, don't hesitate to reach out to your HR department or a financial advisor for guidance. It's better to be safe than sorry, and you don't want to risk violating company policies and facing disciplinary action or even losing your job. 2. Investing in your employer's stock. Investing in your employer's stock can be a great way to show your commitment to the company and potentially earn a return on your investment. However, it's important to be aware of the risks involved. One risk is that investing in any individual stock can be risky. If the company experiences financial difficulties, the value of your investment could decline. Additionally, if your investment portfolio is heavily concentrated in your employer's stock, your financial well-being could be heavily tied to the performance of the company. This could put you in a vulnerable position if the company experiences a downturn. Before investing in your employer's stock, consider diversifying your portfolio with other investments. You might also want to consider setting a limit on the percentage of your portfolio that's invested in your employer's stock. This can help you manage the risk of having too much exposure to one company.
If you are enjoying until now, don't forget to hit that like button and subscribe to our channel for more fun and informative content. My name is Ibrahim. I hope you are doing well. Now, let's go back to my friend Jack.
3. Investing in a 401k plan. If your employer offers a 401k plan, take advantage of it. A 401k is a tax-advantaged retirement savings plan that allows you to invest a portion of your pre-tax income. Your contributions grow tax-free until you withdraw the money in retirement. One of the benefits of a 401k plan is that your employer may offer matching contributions. For example, your employer might match 50% of your contributions up to a certain percentage of your salary. This can be a great way to boost your retirement savings. When investing in a 401k plan, it's important to consider your investment options carefully. Most plans offer a variety of investment options, including stocks, bonds, and mutual funds. You'll want to review each option and consider your risk tolerance, investment goals, and time horizon before making any investment decisions. It's also important to remember that a 401k is designed as a long-term savings vehicle. You won't be able to withdraw the money without penalty until you reach age 59 and a half. Withdrawing the money early could result in taxes and penalties. 4. Investing outside of your employer's offerings. If you're interested in investing outside of your employer's offerings, there are many options available. Two popular options are individual retirement accounts, IRAs, and brokerage accounts. With an IRA, you can invest in a variety of assets, including stocks, bonds, and mutual funds. You can also choose between a traditional IRA or a Roth IRA, each with its own tax benefits. With a brokerage account, you can buy and sell individual stocks, bonds, and other securities. This can be a more hands-on approach to investing, but it also comes with more risk. When investing outside of your employer's offerings, it's important to consider your overall financial situation. Do you have an emergency fund in place? Are you carrying high-interest debt? Investing should come after you've addressed these other financial priorities.
Hello investors and wanna be invested. Did you know that investing isn't just for the famous and rich? Yes, who says we can't make our money work for us. So if you want to learn more about investing, don't forget to subscribe our channel, hit that like button. Don't be shy, we won't fight, but our financial tips might give you a little nibble of success. Hey Jack.
5. Working with a financial advisor. Investing can be complicated, and it's easy to feel overwhelmed. That's why it's important to work with a financial advisor who can help you develop a comprehensive financial plan that meets your. Investing as an employee can be a smart way to build wealth and prepare for the future. However, it's important to understand the risks involved and to make informed investment decisions. By reading and understanding your employer's policies, diversifying your portfolio, taking advantage of retirement savings plans, considering your overall financial situation, and working with a financial advisor, you can make investment decisions that support your long-term financial goals.
Ladies and gentlemen, if you want to get more investment tips and achieve financial freedom, don't forget to subscribe to our channel. Check out other videos. You can find it on the screen now or in eyesight. Thanks a lot for your support. Peace.